timing is everything. And with AI, my opinion is that as a startup, you cannot educate a market.
It takes too much time. You will go bankrupt before that. Most of the time.
Absolutely.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Sylvan.
Philippe, a very well welcome to the Swisspreneur Show. It's a pleasure to have you as probably the third co-founder of Yokoy on the Swisspreneur Show. Thank you for being here today.
Thanks for having me. I mean, there are 5 co-founders, so
That's
you have
true.
a couple of more to go.
More work to do.
Really glad to be here. Thank you.
You are the co-founder and former CEO at Yokoy, a platform that automates spend management for medium and large enterprises with AI. Of course, we're going to talk all about that, from the founding years to the exit to what you're doing now and in the future. But I actually want to start with your career. You started in process optimization at EY and UBS. Then you jumped into the CFO role at Beekeeper. And I wonder, when did you realize that you're done optimizing and supporting other people's companies and it's time to start your own?
I'm actually really glad that everything turned out the way it is, because starting out a company right after college must be really hard. I haven't done it, obviously. I first went to EY and then to UBS. But the times at EY and UBS, they have basically given me the network that I really needed, the friendships, and also a bit of experience in the business world. And since I did all of that in Switzerland, for me it was very clear, if I were to start a company, do it in Zurich or in Switzerland. It's the place where I had all my people around me, the network. I knew a couple of people in the business. And I mean, if you're planning on starting a startup, I always say, just make sure you enter the career world somewhere where you meet a lot of people and where you can see into different companies. And at EY, I mean, as a consultant at EY, that was the perfect setup for me to meet different people in different companies and also to see how different companies operate and also to see the inefficiencies. Like, where is potential? Where can you, and there's still a lot of potential in a lot of companies.
I totally see and also value your point. I did start my first company right after university.
That must be hard.
It's actually, I feel it's easier because
Okay.
you are a bit naive. That's something that people on the podcast say over and over again. They say, you're so naive. You don't think about how hard it will be, how difficult it will be. So you just keep going. So I felt that really helped me. And also, I feel in Switzerland, you often then have a corporate career. You start to make more money and more money. And then that switch, I feel, for many people gets harder and harder because suddenly you go back to almost zero salary or very little salary compared to your corporate career. So I feel the switching costs, the bigger your career, the bigger the switching costs.
No, you're 100% right. So I think the naive part, I mean, I think I am a bit lucky. I'm still naive today.
That's good.
I'll probably never learn. So it's something that didn't kind of stop me. But you're right. I mean, I think most kind of like the general people would at one time, probably lose that naivety and get more into kind of like the serious part. So I think I never lost that.
That's a good trait to have, honestly.
As an entrepreneur, it really, really is. The other part, you're also very right. I mean, once you have a career, I mean, you get comfortable. You build up a lifestyle. For me, I saw it slightly different. I mean, I got a bit of money while I was working at EY, UBS, and I could then finally use that money to start a company.
Fair. Yeah.
And I could kind of like, I had now the luxury to go 1 year without a salary, which I couldn't do straight after college. I mean, you will always find a way. But
if you really want it,
if you really want it, you always find a way. But I still think it was kind of more comfortable for me because I had a bit of a cushion. Like now it's like I can spend a year and then if it doesn't work out, it's all fine. And I mean, for me, it wasn't that radical change, as you mentioned, from corporate to startup. I actually did the step in between. I went to a startup, to Beekeeper, which I'm very grateful for. I mean, if you come from the corporate world, you don't really know the startup world. I mean, and even if you took some entrepreneurship class in college, not the same.
You have to do entrepreneurship is something you have to do. Otherwise,
100%, yes. And I mean, a beekeeper, I really learned the startup stuff.
Of course.
Fundraising, what are the metrics you need to look at? I mean, really, how does a startup actually work? Yeah. So for me, that was probably one of the more important educational experiences I had for afterwards then starting my own startup.
I'm not surprised at all. How did you manage this transition? Was it difficult to switch from the corporate world to a scale-up world with Beekeeper? Or what helped you adapt to this new environment? Because I imagine it still to be quite different.
Yes, so I think my naivety that helped for sure, and the kind of the drive to build something. And the frustration I had when I was working in corporate certainly helped. I finally could now do something. It took quite some time. I remember I was probably the only one in a suit when I arrived at Beekeeper. I'm not sure if they still remember, but I'm sure Chris and Flavio and the Beekeeper folks, they still remember.
Who is this weird guy showing up in a suit?
Yes.
Are you like our banker or who are you?
They were probably like, oh, he's running finance. That's probably fine. Yeah. That's what they do. But for me, it took a bit of time to adapt. And I must say, it was such a great experience for me. And it kind of helped me to really focus on the relevant stuff. Mm-hmm. And that's what Beekeeper did very, very well, in my opinion. It's like, hustling as a startup to just make sure that you get to that next goal, to that next funding round. And that's very different to corporate. In a corporate, you just work to the next, especially a public company, you just work to the next kind of like quarterly targets and, plans and all of that stuff. And I mean, for me, I was not long at Beekeeper when I realized, on one hand, I don't want to go back. There's no way I want to go back to corporate because I can finally do that stuff. It was more work, for sure. No. Night works, basically the weekend shifts. But for me, it was so satisfying. It was fun work, interesting. And it didn't take too long for me to then have that kind of spark to, hey, and that coming back to your question now, it's like, I could actually, start up my own kind of company. And that was certainly helpful for me to also have kind of that confidence that I know how the startup world runs.
That's amazing. So take us back to Zurich in 2019. What convinced you that spend management needed a radically different approach? What was going through your head and what were the conversations with your co-founders like?
Yes, so Zurich 2019, I mean, on one hand, it sounds like a long time ago. On the other hand, it really is just 6 years ago. Back then, we didn't know that the pandemic would be coming. So it's like, it does sound like, oh my gosh, that's a long time ago. But for us, it was basically the time when we, or, kind of the entire team realized we want to build our startup, our own company. So that's one thing. It's like we were ready. We were talking about it over beers. It's like, It's kind of like us building a team already, a founding team. And at the same time, I was also thinking about what kind of like idea would be kind of the next big thing or could be the next big thing. And it was already quite strategic because fintech was on the rise,
right?
Was coming. And the AI part, which were the two most important things of Yokoy, where the AI part was kind of in its baby shoes back then. And we realized that if we combine the AI automation capabilities with that big problem of, fintech automation, we can build something that will really be needed in the market in the coming years. So AI and fintech really played a really big role for us to kind of shape what was Expense Robot at the beginning and then turned into Yokoy later on, and then Perk even later on. And for us, having the right team, having that right idea space kind of helped us to really become concrete. Like, so what is the first problem we want to tackle? And we wanted the first problem to be kind of not too broad. It needs to be a kind of a very specific topic that we can build an MVP on, that we can win some customers, and then also kind of start very, very quickly. And expense management is is very nice in that sense, or it's a nice area because expense management is typically a smaller part of the company's kind of like accounts payable or of the company's P&L. But on the other hand, it's still a topic that touches a lot of people in the company, like the travelers, the managers who need to approve, and the finance team anyway, who needs to post and, archive and reconcile. So it's one of those things people also talk in the evening about. It's like, oh, I went on this amazing business trip and now I have all those receipts. Oh, no. So for us, it was kind of, we found that thing that we really wanted to revolutionize. Mm-hmm. And what we did very well, I think, in the beginning was having that vision. Our vision was expenses on autopilot. Very simple, but it described exactly what we were doing. It's like we wanted to build a tool, a software, a solution that can take expense management onto a level that an autopilot already has in aviation. So kind of like every expense that flows through it kind of gets fully automatically processed, except for inconsistencies, where the alarm bells go off. That's when a human then needs to interact and kind of like take it from there. So the entire company from the very beginning, it was us 5 founders in the beginning, had that big vision, expenses on autopilot. And we knew exactly that whatever we do every day needs to bring us closer to expenses on autopilot.
Was your time as CFO at Beekeeper also shaping this product understanding because it was sort of your own problem that you experienced yourself back then?
Yeah, it was funny enough that the idea actually came from Davis, who was traveling a lot for EY. I got to know Davis at EY, and he was traveling a lot, and they were using one of the old legacy expense management tools at EY, and he was so frustrated. And then he became a manager, and then he also had to approve expenses, not only submit and file.
Even more frustration.
And I remember he was like, "Oh, there must be a better way." Yeah. And for me as a CFO of a kind of like a startup, I was like, yeah, I mean, we have kind of like a similar issue at Beekeeper. We also want that to be that problem to be solved. And we all knew the issue, and we all had kind of a passion to solve it. And that helped us to really bring that idea of expenses on autopilot very, very early on onto the table to discuss as one of the options.
Yeah, I love that. I think solving your own problem is one of the most powerful things to do.
100%.
How did your first version then look like? Take us back to this very first, maybe MVP or the first official launch that you guys did. What was the platform like? What was the initial customer feedback?
Yeah, it was actually revolutionary because, and today it's really not anymore, but back then it was revolutionary because what we did is we used the AI available. So we did not do any AI research ourselves. We used the fundamental AI that was already there, and then we built on top of it. And what we did is we basically tailored it towards expense management, meaning that when you took a picture of a receipt back then, what kind of like all the other tools did was they read out a couple of things, like the amount, the currency. What we did, however, was we basically tried to understand the receipt and build an accounting posting in the background already, just to make sure that we actually solved the problem from A to C. And kind of that was revolutionary in a sense when we were demoing. It's like, look, now take a picture, and a couple of seconds later, we had the accounting posting already on the screen. And that was that, wow, it's like, there's actually something that happened between a picture and, the end goal of correctly posting it in the ledger.
That's amazing.
So that was it. I must admit, it didn't look good. We didn't have a designer. It was the tool looked terrible,
but it worked.
but it worked.
That's the thing.
And I have one fun story. We love our CTO, Davis, and he had that big vision of everyone coming away from apps and going onto web apps. So he was like, I'm not going to build an app. I'm only building a web app. And when we rolled out the first customers, we basically told them apps are dead. It's like no one uses apps anymore. It's like web apps is the big thing. And they were all like, what is a web app? It's like, but I don't find it in the app store. It's like, yeah, but that's the thing. It's like, that's a web app. It's like, so a couple of things that we tried didn't work. I was like, obviously we had to build a proper app that actually went on the app store at the end. But we always try to be revolutionary. We try to be a couple of steps ahead, but react very, very quickly to the market when we got the feedback, hey, no, that's not what we want.
But I mean, that's what makes a good startup, right? You have strong assumptions. You go out there, you test them, then you probably get hit in the face 9 out of 10 times. Yeah. You change it and you adapt, and then you build something that actually works.
Yes, absolutely. And it's also part of the fun. It's the fun stories you then tell each other later on.
That's true. And one thing that stuck with me is in 2019, AI, of course, it was there, it was coming, but it was not a hype as it is right now, end of 2025. What did it look like back then? What AI solutions did you work with? And what made you make this bold decision to go all in on AI without even knowing that AI will probably be the biggest hype a few years down the road?
Yes, that was, it actually was part of a long discussion we had. We tried to solve the problem. So AI was just basically for us part of the solution to a problem. The problem was look at a receipt and try to understand what it is and how an accounting posting could look like.
Yep.
Now, if you do that rule-based, it's hard. It's really, really hard because receipts, they're not standardized. Even invoices are, there's no standard for an invoice, especially not for the, for the ones that still get, printed out or PDF invoices. But there's a little bit more standard there. But for a receipt, there's really no standard. Everyone can kind of I think there are a couple of things you need to put on, but that's pretty much it.
It also very much depends on where you travel, for example, right? Receipts in Switzerland can look very different than to receipts from the US, for example, or Asia. I don't know.
Absolutely. And oftentimes, when you have a receipt, you don't even know where it's from.
No.
And especially if they don't put the name of the restaurant or whatever on there. So we basically, or Davis at the end came up with so we need something that learns out of the data that we already have, out of the hundreds of receipts, which turned into millions of receipts later on, and makes our tool get better with those.
Nice.
So AI was kind of the thing that, was out there for years already, but more in the research space and less in the consumer space. Yeah. And he came up then with kind of some AI models that were out there already that he could use. And what was fantastic was we could see how the model improved. With more receipts, Amazing. The tool got better. Yeah. So the story to our customers was also very, very convincing and extremely cool because look, if you use Yokoy and all the others use Yokoy, your tool will get better on a daily basis. Yeah. And especially for new countries, because our tool was kind of good for Europe in the beginning. But if you travel to Asia, to a country no one ever had filed an expense with Yokoy, it was probably terrible.
Fair enough. Yeah.
So it was kind of that story, be part of that revolution of Yokoy, help us build the next generation of expense management. And a lot of Swiss companies really want to help. They wanna, they wanna help building cool stuff, bring the research further. Mm-hmm. So a lot of people really like that. And what we always said, which is absolutely true, is in today's world, you don't want to implement a tool or a solution anymore, which gets outdated in 2 years or in 5 years.
Of course.
You want to build or you want to implement a tool that actually learns and grows, learns on your data, gets better. And in 5 years, you basically have a tool that has learned over 5 years on your data and is so good that you actually don't want to replace it anymore.
That's also a strong lock-in effect. at the same time.
It's
100%.
a win-win. For us, it's a lock-in as a provider, and for them, it's basically the opportunity to get a tool that is tailored to themselves.
Yeah. And then you now found something that works. You have the technology that's working. You had this wow effect of the first customers. When did you then realize, hey, we're onto something? We probably hit product market fit. Now we need to scale and really, really go big. What was that feeling when you felt for the first time, this might be it, this might be product market fit?
Yes, it was actually quite early on. We had a couple of customers, we had a tool and a couple of integrations into ERP systems, which was the most important kind of integration we needed. And we realized that companies would basically come to us as like, we have heard of Yokoy.
Amazing.
It was implemented at my friends' companies. Like, can we not also try it out? So for us, it was the time we realized, hey, we have a technology that works. We have customers that love it, that speak on behalf of us. And we have a team that can manage basically the company in a sense that it's kind of like it's growing and getting better on a daily basis. So that was those different things that started the pull effect. And for us, it was not spending more money on marketing or sales. It was really about customers basically starting to approach us.
I love that. This is really when you think about the Net Promoter Score,
Yes.
right? These are the 9s and the 10s that actually refer you. That's a very, very good signal. I love it.
It was the time also the metrics were by far the best in the company. If you start scaling, then you make some costly mistakes,
Sure.
And which actually makes your metrics look not that great anymore. So it was the time we certainly had the best metrics of all times.
And talking about scaling, you often also encounter fundraising. You guys pulled off something incredible. Your Series B was an $80 million round. It was back in 2022, and it was led by Sequoia, probably one, if not the best VC in the world, sort of. What made you decide that this was sort of the right partner and to take them on or even try to win them? Because it's also a very big ambition to eventually win Sequoia as an investor.
Yes, for us, it was always clear we want to be the number one expense and then which turned into spend later on platform in the world. So that was always clear. And expenses on autopilot was kind of like the big vision, which then turned into global zero-touch spend management. But for us, that big ambition to go global, go be the best, the biggest, kind of like the leader by far, helped us to kind of like also shape that narrative. Like, so if we want to go there, who do we need? And when you come to fundraising and money, then, I mean, Sequoia is probably the dream investor of every tech entrepreneur.
100%. Yeah.
It's like that, what they have pulled off in the last, 20, 30 years is absolutely incredible. And with good investors, you get more than money. You get a sparring partner, really, who helps you throughout the entire, journey, in good times, in bad times. And for us, Sequoia was always kind of the goal, the thing that we wanted to get on board. And we reached out to them and we had never heard back.
Of course. Probably one of the million cold emails, cold outreaches.
Yeah, we submitted the pitch deck, never heard back. And so at one time, they approached us.
Wow.
Because the story, at least the story was told to me, is that Sequoia realized that in the US, Bill.com was a huge success story. Yeah. And Sequoia at that time, during the pandemic, then kind of like started an office in London to tackle the European market. So we were contacted out of the London office, the newly established London office, which was established by two partners of Sequoia, Luciana and Matt. So Matt reached out to us with his team, and they were trying to find the Bill.com of Europe. The theory behind, which totally makes sense, is the Bill.com solves a problem that exists everywhere in the world. Bill.com did a really good job in the US. The US is very different in terms of spend, cards, accounting to Europe. So the chance that Bill.com would go and conquer Europe is quite small. So there must be a European player in that field that becomes kind of like the market leader. And they started to scan the spend management ecosystem. And they talked to obviously all spend management players in Europe. Since we were the best. No, I'm kidding. No, but at the end, I think the reason why they chose us was technology and the team.
No.
I mean, as an investor, the team is what really brings the best out of the company, pivots whenever needed, and kind of makes those things. And the technology is something that gets harder and harder to change the bigger you become as a company. And I think all the companies they looked at, it was their growth team. So all the companies they looked at were already at a certain size. Mm-hmm. And us with kind of that AI at the core, we had a huge advantage. Plus we had a big customer base, customers talking very well about us, referring us. So there's a lot of things that came together that helped us at the end to really raise the 80 million round from Sequoia.
It really is striking to me how important the timing is. You were at the right spot, you had a good growth, the customers were talking very well about you, but at the same time Sequoia opened this European office to tackle the European market. So those things have to come together at the right moment that the deal like that can happen.
Yeah, 100%. I mean, there's a lot that timing is everything. Yeah. I mean, obviously you need a great product and team, but timing also when you start a company is like with the product, timing is everything. And with AI, we were probably at the right time, maybe half a year to a year too early.
Yeah.
Because in the first 6 to 12 months, we had to put a lot of resources into explaining what AI is. And my opinion is that as a startup, you cannot educate a market.
It takes too much time. You will go bankrupt before that.
Time and
most
money.
of the time.
Absolutely, absolutely. I mean, if you're too early, it can kill you.
Yeah.
Because, I mean, it's such for us, talking about AI to a CFO or someone in a finance team who has never heard of AI before, this is hours and hours of education, convincing. It's like not something that's scalable at all.
Right. Then I also envision, so Sequoia got you on the map. They found you through research. How does it then work? Do they just send you an email? Or
they do.
What happened? Because I would then say, oh, this looks like spam. Like, this cannot be real. Like, who would send me an email like that? What happened then? So they sent you an email. What made you think it was real? And then how did the process after that look like?
Oh, I'm naive. I thought that was real from the very beginning. It was my dream already. It's like, oh my gosh, Sequoia reached out. It would have been disappointing if it weren't real. So for me, I was already in talk with a lot of investors, and we already had Series A closed, back there, Series C and Series A closed. So we had a bit of experience, a couple of meetings with investors already from the network back then. And we were ready because we had a pitch deck for Series B, even though, it came very, very shortly after Series A.
Right, yeah.
So it was basically the Series A pitch deck turned into Series B pitch deck. So we were ready, and for Sequoia, you're ready anyway. You have to be ready. And we went into that meeting. I do remember today. It's, not unprepared at all, but just with our knowledge that we had about the company, we knew our metrics very, very well. We knew our customer segment. We knew where we wanted to go. And with that, we had a really good first meeting. And for us, it was always really important to understand how do investors look at a company and the market, and how do companies look at the market, and kind of like building that bridge is part of the job of a CEO and a founder, in my opinion. It's not always easy because the investors typically come from a bit more an abstract and higher level, bit more theoretical view, while as a founder, you're a bit more emotional, a bit more customer driven, because you're always in touch with the customer, so you hear the feedback directly. And building that bridge is probably one of the big difficulties if you want to truly impress an investor, don't talk about the lunch you just had with a customer and their problems. Talk about the market, how you fit into the market, how you're different. Then use the customer as an example. It's like, and by the way, it just got confirmed today when I was talking or having lunch with that customer who bought because of that and that reason.
You really have to adapt the message depending on the audience you're serving, basically.
Yes. Yeah, absolutely. And but that's the fun part of the founder and the CEO. It's like when you talk to a customer, the message is different than when you talk to your team, than when you talk to partners, than when you talk to investors. And I mean, I can imagine it's probably also the same for a CEO of an SME or a larger company, but it is quite extreme in the startup world.
And then there's a rumor that you actually raised at the crazy valuation, this Series B round, at 100x ARR multiple. Is that accurate?
So, okay. Rumors. No, look, I mean, back then in 2021, 2022, the multiples were crazy. I mean, we were, the multiples went way above 100x. And for us, I mean, what I can say is we were certainly around that when we did our Series B round. And for that time, wasn't it all crazy?
It was what the others were doing as well.
It was absolutely normal. It was the time when negative interests were in force in Switzerland. And in the US, we went to very low interest rates. Not negative, but we went to very low. And it was the time when kind of like everyone was looking for an alternative to whatever didn't pay anymore. So that also kind of makes multiples go crazy. Then I wouldn't say it was a bubble, but you have kind of bubble-like symptoms. There's like, and you have FOMO. You have really companies or VCs competing with each other, really wanting to find that next Meta, that next Google, Alphabet, whatever, Nvidia and Tesla and whatever. So that kind of helped to put together quite an ambitious Series B. But at the end, I mean, if it works out well, then it doesn't really matter what the multiple is. And if it doesn't turn out well, it also doesn't really matter what the multiple is. So you could argue that, the multiple should be somewhat normal, kind of like market standard. But at the end, you as a founder, you really want the best for the company. And if you get 100x this time, you might want to get an 80x in the next round and whatever. It will go to a kind of a normal 6 to 10x once you get closer to IPO anyway.
Have you ever regretted that you raised at such a high multiple? Because you said, okay, it doesn't really matter if it's going very well, no one cares. If it doesn't go well, also no one cares.
Yes.
But I imagine it also limits sort of your options at one point, right? If you raise at the too high of a multiple, you cannot simply say, oh, we got an acquisition offer, but it's just too low, because then with that multiple, maybe the acquisition offer is much lower. And with a lower multiple, let's say very conservative, like a 10 or 20x multiple, you could have made that deal and everyone was happy. Were there any regrets of raising at the too high multiple?
No, never. No, we wanted to, conquer the world. And so we did kind of until we found TrialPerk. And it all turned out well with TrialPerk together. I mean, no, not at all. Would I do it? I mean, I wouldn't optimize for the highest multiple anymore. Back then, I think I certainly did, because it was me being even more naive and me being kind of like that. I want that, 100, 200x, and then we go to a 50x when we're at 50 million, something like that.
Right.
But for me, now I kind of realize that, it's probably less important in the full picture, because if it goes well, it really goes well for everyone anyway. And otherwise, yes, same is kind of true for the opposite. If it doesn't turn out well, it doesn't turn out well for anyone. And kind of like the medium things that are always difficult for companies that scale at such a fast rate.
For sure.
This is pretty much no option. You cannot turn into an SME at one point.
It's go big or go home.
It's really go big and go home. And it's also something that everyone needs to be aware of.
Yeah.
In the board, in the investor circle, in the company. I mean, this raising awareness for that, what is the strategy of the company is hugely important.
Absolutely. So then the deal closed, obviously. That's why we're talking about it. And I imagine Sequoia, they have an incredible reputation, the best VC in the world, as we discussed. But at the same time, I can imagine that also sort of changes the pressure profile on you as founders, on you as a company, because explicitly or implicitly, there are now certain expectations to really deliver an outstanding, a huge outcome. What did you immediately feel after closing that round? Did something change for you, how you felt pressure from the VC?
Not for me, but I can imagine that certainly for a lot of people, it would change. So for me, personally, I am the person who puts the most pressure on myself. And I don't really care much about, the outside pressure. And it has never impacted me until now. Because the expectation of myself is way higher. So for me, I really enjoyed the benefits, though, of being a Sequoia company in all sense. Hiring, people start, reaching out. I want to work at a Sequoia company. Customers, advisors, really getting the best advisors, getting into the base camps of Sequoia, which is, the annual kind of like get together of the portfolio company CEOs and sometimes, founders, where we met Elon Musk and all of those people in the Valley, which is absolutely amazing and really helped us a lot. But for me, I think you need to be inherently driven and inherently driven. It's like as a founder, if you want to go that big. So not much has changed in that sense.
And what were the hardest moments after the Series B funding round? I imagine, it's never a straight line just up to the top right. There are always ups and downs. There are moments where you are behind the plan and the VC might not be happy. What were some of the hardest moments after the Series B? You didn't feel the pressure because you applied more pressure to yourself, but I'm sure there were still some tough moments after that round.
Yeah, every day, every day. I mean, for me, the toughest moment was when I realized that the company had lost the sense of urgency. This is something that I really underestimated. We became very, very big. I mean, at one point, we hired 20 new people in 1 month.
You were more than 200 people at one point, right?
Going to 300 plus
Jesus,
people. Yeah. It was crazy. And that, I mean, you can do that. That's 200 people or 300 people you can leverage very well. But if you get 20 new people in a month, and the next month 8 new, and then 12 new again, a company cannot really absorb that. I mean, it's really, really hard. So for us, becoming kind of like, I wouldn't say a corporate, but becoming that different type of company very, very quickly was very difficult. And we didn't manage as well as I was hoping we could. And at one time, we really realized we had lost that sense of urgency. And sense of urgency is by far the most important thing in every company, or it should actually be in every company, because a company today, you cannot be sure that tomorrow you're the market leader still, or it's like you need to reinvent yourself constantly.
Now more than ever,
which is a good thing in my opinion. And that sense of urgency, we had it in the beginning. I mean, it was crazy. If we wanted a customer, we did everything possible for that customer or for that prospect to win it and become a customer. And the point when I sent out messages or started talking to people and they were like, yeah, that's a great idea, I will look at it next week. I mean, I turned red. I became as mad as I have ever seen myself. And because excuse my English, what the fuck next week? It's like, it's, I don't know, it's Thursday, it's Friday, it's like you have 2-3 days until next week. Maybe the competitor does those things in those 2 days or 3 days, and then you're behind. It's like, stop it. It's like, do it right now. And I mean, can you expect that of everyone? This is a huge topic, I guess, at its own. But the reality is, in my opinion, if you're especially a startup that wants to grow, that needs to grow and scale fast to become relevant, to become the market leader, who is not a market leader at the moment, there's no way you can do that with 8 hours of work a day. There's no way. You can take breaks, and you should take breaks, no question asked, but you need to go above and beyond and be smarter, dare more. It's like, just, you need to be different, faster, just to be able to get to that point that others would say, oh my gosh, this is crazy, this is not possible.
Fully agree. That is part of the game that you're playing. To what extent do you think it also changed the perception or even the company culture a bit? Because if your employees read, oh, you raise 80 million from Sequoia, I can imagine people also start to get a bit comfortable. They're like, oh yeah, we have the money in the bank. Now we're funded for a while. Maybe we can shift 1 or 2 gears back. Did you experience that maybe the big funding round could even be counterproductive internally a bit?
Yes, in the very beginning we did. I wasn't prepared for it, but I think it's also the job of the CEO to then kind of like change that completely immediately. And the way I did it was, I told them every month what our burn was. And I explained it in a way that, look, last month we spent, let's take a fictional number, $3 million of the investors, not of your money, not of my money. We spent $3 million of the investors' money to basically be where we are now.
Yeah.
So this is not the time to get comfortable. It's the exact opposite.
We're losing money.
We're losing money every single month, and it is okay. But we need to be aware that every single month, we spend the money of our investors who believe in us as a team to get better, to get to that target. And I think people realize when they hear, oh my gosh, $3 million in a month from investors, like, they must trust in us a lot.
Right.
They realize, like, it's not the time to ask for a salary raise. It's probably the time to, shift gears and, just do your best.
One really important point there is also the incentivization of the team. How did you guys set the incentives? Because I feel you can talk about everything, they can understand it, but in the end, tough times, good times, people behave the way that they are incentivized. Yeah. How did you structure that to make sure that there's still a sense of urgency, that people actually wanted to get stuff done and grow fast and give everything they have?
Yeah, I don't have the right answer there, because what we did is we gave equity to everyone. Every single employee at Yokoy had equity. But not every single employee had the percent. That just does not work mathematically.
300%, right?
Yeah, plus investors would like to have something as well, and founders as well. Yeah. Trust me. So it is, even if you incentivize everyone, it will be kind of like a smaller portion, and it will not make everyone multimillionaires. Even if in the NVIDIA case, maybe the first 100 became millionaires, but this is the top 0.0001%.
Sure.
This is pretty much impossible. But for me, it was important that everyone has equity, an equity stake, and wanting to bring the company further by making it more valuable. Was it the right decision? It's really hard to say. On one hand, it's a huge administrative burden. Yeah. Huge. This costs a couple of $100K a year, because you have people that just need to, issue new grants, and then they get executed, and options, and here and that, and so.
Luckily, we have a Swiss startup supporting.
Luckily, we have a Swiss startup. Hello to Lecce. So yes, it's really, really hard, especially if you're a global company.
Of course.
Really, would you do it again? Probably not.
No.
Not because I don't want to give it to the people, just because it is really hard to show the value of those options or phantom stock or real stock or whatever it is at the end. And it is hugely distracting.
No.
But having the right incentivization, as you call it, and as you say, is absolutely right. I just don't know what it is. I mean, maybe it's a bonus when hitting a number, something like I don't know.
It can also be very dangerous at the same time, right? If you set the wrong incentives, you completely misalign the team.
Yeah.
I also don't have the right answer, but one thing I heard coming up over and over again is that people don't just get the phantom stock options or whatsoever free of charge as part of the salary package, but they actually have to do a buy-in. They have to put their own money at stake to buy a share of the company at whatever valuation it is back then, to then really have skin in the game. And I feel then they have something to lose. And that's a different psychological shift than just getting something and you don't even think it might be valuable, and then you might not make a profit, but with your own investment, you actually have skin in the game and you have something to lose. I feel that's probably the closest I got so far, but you can also not do that with everyone, I assume.
No, you're 100% right. Maybe you even can. I don't know. It's probably a really good way of doing it. I would certainly take that into consideration. Also, another one that's important is secondaries.
Right. Yeah.
And I'm not saying that you need to pay $1 million to everyone in secondaries and buy their shares, but secondaries allows people to get a tangible value or to realize a tangible value over their shares. And the more often you do it, the better it is, in my opinion, to kind of like to have or to make sure that people see value, real value in shares or in options.
Yeah, for sure. But then also you don't want to give them too much money that they get too comfortable again, right?
Or then I'm just going to kick them out.
Okay, fair enough. One last topic in this area, you mentioned this sense of urgency, right? So you pushed your team. Of course, you say it's important to take breaks, etc. But I imagine there you then also have, especially with 200 to 300 people, this sort of trade-off between, hey, we want to move fast, we want to go bigger and grow like crazy, and sort of burning out the organization. How did you experience this trade-off or this act of balance between pushing harder and harder versus not burning out the organization or at least certain teams or team members?
Yes. I mean, for me, it's a lot has to do with communication. And if you tell people already from the very beginning what the company culture looks and giving them also very early on responsibility and accountability, then you can fight that very well. I mean, you need to be rigorous, very strict. And a lot of people will tell you in the interview, I'm ready to work the weekends and I make the decisions. I mean, I'm not a big fan of interviews anyway, but I mean, they probably tell you what you want to hear, which is absolutely normal. I would do that as well. But for me, kind of having that first conversation already during the interview phase helps, because you want to be fair as an employer and as a startup. And you want, whenever it doesn't turn out, you want to be able to say, hey, look, I did whatever I could to find the person that fits that role the best.
Yeah.
But if it doesn't work out, cut early. Yeah. I mean, cut as you can. I mean, most companies, pretty all companies, cut too late. And we are, especially at Yokoy, we were really not a company that wanted to be, just the most, how should I say that? Like just a regular SME where you come to work in the morning. And we want people who have that extraordinary drive that you can't find in most of the people. Kind of someone who has that inherent interest in making a change in the world through technology. Yeah. And for those people, they most likely would succeed in one or another role at Yokoy, either as an individual contributor or as a manager, when you then have to make decisions. And that kind of like coming to your point, they need to take responsibility of the decision they've taken. And with that, if you have that culture, which a couple of startups in the world have actually been able to establish that culture very well, and this works. It's probably the best playbook there is.
No. So then people are in the flow instead of burning out. That's basically what you're saying,
Yeah.
right?
Yes, absolutely. People, I mean, the chance that I myself would burn out is quite small because I love what I'm doing.
Yeah.
It's like, I'm not a psychologist at all, so I can't tell you when someone burns out, not. But what I can tell you is I don't want anyone in my organization to burn out. This is,
Of course.
this is
Yeah.
the worst. You don't want that. You want everyone to be healthy. Because if someone is not healthy, doesn't feel well, they cannot. I mean, that doesn't work out. It's not good for society. It's not good for the company. So the interests are aligned. We want everyone to be healthy. Absolutely, 100%. But the company was not a place where everyone could thrive or be healthy. Just a very specific type of person that is motivated by exactly those things, like really wanting to change and having fun at doing that. But you can always take the weekend off. That's absolutely fine. Sometimes you need to recharge. I mean, one doesn't really exclude the other.
Absolutely. Now let's leave this topic of incentives and the org structure and actually talk about the exit, probably the topic that most people are waiting for. It happened in January 2025. TravelPerk acquired Yokoy. Why was it the right time for you to sell in that specific moment?
So the world has changed a lot since 2019, and expense management tools and spend management tools, a couple of them have become quite good. Market share was quite distributed, so there was no clear winner that time. We also should say that Yokoy was kind of the last one to enter the race. So we were the last ones and we came very, very far. But for that next step to really become, as always mentioned, that leader, we realized that we cannot be a spend management tool alone. Spend management became a silo, and you don't want to be a silo anymore. You need to be able to holistically and kind of like from beginning to the end automate a process. And travel and expense has always been very, very close. And travel is hard, I can tell you.
I imagine.
It is like, I underestimated that big time. I mean, there was pretty much no chance for us to build a travel tool. We could have partnered with a travel tool or with a travel provider very closely. That was kind of the other alternative. But on the other hand, that wouldn't have gotten us to what we can do now as one company together to really basically be one app.
No.
So you would still have to, I mean, if we partnered with one, you still had two apps, like book travel here. But with travel, you all know, it's like your flight is canceled. Your hotel cost is not 100% aligned because you bought something in the minibar and then there was some weird taxes added at the end. Like just stuff doesn't add up. Travel industry is also a legacy industry in a lot of areas. And for us, we didn't have that many really cool travel partners, also to be very, very honest. A lot of them were very legacy partners and they didn't have the same drive and speed as us. So with TravelPerk, we basically found a partner that had the same ambition, the same speed, kind of a very, very adjacent industry where we already needed to partner anyway. We already had more than 20% of our customer base was already using TravelPerk as a travel
That's
tool.
a great sign. Yeah.
That's a great. So almost every fourth customer already used both tools. Yeah. And a lot of them struggled with the integration, also to be very, very honest. So we wanted to bring the best out of the two worlds by combining us and creating something that cannot easily be replicated. Because entering the spend world, very difficult. Entering the travel world, very difficult. Entering both together, almost impossible, especially if you start out now. Yeah. And if you want to be the leader as we want to be. So what we did is we basically, we sat together and we're like, so what do we do? How do we make the most and the biggest impact in the world and win the game? And the decision at the end was unanimous. It was like us joining forces and becoming one company. And that was the beginning of acquisitions and mergers are always extremely difficult. So it was the beginning of a really, really interesting time.
What you just described, I think many founders find themselves at one point in a very similar position where you say, hey, we have these big ambitions, these big visions, but the market is consolidating or the market is difficult. So maybe we will not fully get there on our own. To what extent is also your, let's say, founder part playing a role in there where you say, hey, maybe it's not the same amount of fun anymore, or maybe I don't have the same drive anymore? Because I know we founders always have ups and downs as well, where you just say, oh, I just want to quit this. Let's leave this behind me. To what extent does that also play into such an M&A discussion?
For us, it didn't at all, because it's not about us. It's about the company.
Yeah.
And the company is better off together with TravelPerk. There's no question, especially now for the next phase. And we all knew that. We all knew it. And if it goes well for TravelPerk, it will go well for us as well. And we're there obviously to help as much as we can in the integration and now in our new roles, which is really cool. So it was never about us. It was really about the company, our little baby that we built up over 6 years, that now needs to go another 100 years. Mm-hmm. And we needed to find the right space.
And it was reported that you did a share-for-share exchange deal. Can you tell us a bit more about the deal structure and why that made sense?
The deal structure is actually not public. It was not a full share-on-share deal, but it was a combination, let's put it like that, which obviously is always a preferred way of doing it. And I'm really happy that I'm now part of the Perk group. And, also I'm incentivized in bringing the Perk group further. For us, we knew them already for a long time. And
I think you also collaborated, right?
We collaborated very closely, but we knew each other already since early 2020. And I also believe it's very underestimated at a lot of founders, but it's the responsibility of the founder and CEO to be close and know your partners very well. Even your competitors.
Of course.
You need to know them. Have lunch, have dinner with them. It's like know each other, because at one point you might realize that you're better off together. And that discussion should then not be awkward. And it's also a discussion that might need to come from you.
Yeah.
So you want to know them already, have them on WhatsApp. It's like, hey, let's have a beer. I have an idea. I want to bounce with you.
Yeah.
Just informal, because I think this is absolutely the role and the job of the CEO and the founder.
100%. And it takes time to build trust, and trust is what you need to then get the deal done.
Absolutely, 100%, yes.
Can you also share a bit about the returns? I know you're not allowed to talk about the deal terms, but can I ask you what valuation you sold for?
Valuation is also not public, but let's put it like that. We're all very happy.
Okay.
We're all very, very happy about how the deal structured at the end and turned out. And I think it was absolutely the right way of doing it together. It was my first company that I sold, and I can't compare it to another yet. But for me, it turned out very well in a sense that it didn't take that long. A couple of months of intense work, but we structured in a way that everyone benefits from it. Everyone is aligned on the incentives, which is extremely important. And people were extremely happy.
Was the valuation the same, higher or lower than what Sequoia invested?
I'm not allowed to talk about the valuation.
I have to try. It's my job.
I know. But let's put it like that. The investors were extremely happy.
Okay. Because I imagine you also probably had some difficult conversations with investors, because they want to see you making this big cash exit or even an IPO. And now they sort of became, of course, there was some cash, but they also became shareholder of another company. How did you balance that? Was it also difficult conversations with the investors, or were they like super happy because now there's even way more value based on that deal?
No, we're now much, on one hand, we're now a company as Perk that is absolutely unique and at a place where it's really hard for another one to come to. that is one very important point. With Yokoy, we're always fighting our way up as being the latest one to the game and trying to get, bigger than all of the others that had already head start. And now together with Perk, we are this, gigantic company, travel and spend all together, global. We just moved our headquarters from Barcelona to London and Boston. It's really, there's a lot going on that we couldn't have done. And with Yokoy, we were way below 100 million in revenue. Mm-hmm. And with Perk, we're way above that, obviously. So it's a completely different scale and size. Also, when we talk about, what's coming next, it's like together we are now, this huge thing that has so many different options. As Yokoy, we didn't really have those options. So no, investors are, and especially Sequoia, like they're very experienced. They rather have, kind of like a share at a company that, is so much further than a small or a bigger share of the company that is, probably a couple of years before.
And I think the trajectory is pretty clear. This company is here to go public sooner or later.
I mean, not allowed to talk about that, obviously.
If you look at it from the outside, it's pretty obvious, 3-digit million revenue, going global.
I mean, look, I think the good thing is at Perk, we're doing very well. So we have the options. And that's exactly what you want as a company. You want to have the options to choose whatever is best for the investors, whatever is best for the company. Yeah. And the way we're structured now, we are in an extremely good place. We, as you mentioned, the acquisition kind of like was signed in January, then officially closed in April. And now in November, we have launched our app together. This is amazing. Yeah. Imagine
super fast.
Between April and November, we have basically built whatever was Yokoy and Trial Perk before into one platform.
And what changed for you? Because before you were the CEO of this scale up here in Switzerland, now you're I think your new title is Chief Spending Officer, right?
I'm Chief Spend Officer, yes.
What changed for you? Like, does it feel any different to be part of like a now way bigger company and not being the CEO anymore? What changed for you?
Yeah. I mean, at Yokoy, I was the CEO of a startup with 300 people, and now I'm the Chief Spend Officer of a advanced scale up with thousands of people. So big difference, very big difference. Whatever we are doing, whatever I do now has a bigger impact for sure. No. I mean, and we have different kind of like tasks. So for me, the big goal is to make the spend part of the app so appealing that every customer, also the one that only had travel, wants to use spend as well. This is my big goal now. Before, it was much more about, the CEO tasks. And now I'm much more, I'm not the CEO of Perk. So I'm kind of, responsible for a big area, but not the stuff that the CEO really does on a day-to-day basis.
Yeah. Do you enjoy this new role more or less than being the CEO of your own company?
There are always a couple of things that are nicer and a couple of things that you miss, I think, in every role. Yeah. But look, I loved my job as a CEO and founder. This was absolutely my dream job. And now being Chief Spend Officer is absolutely really cool. I do enjoy it a lot. Something that I had never done before.
Right.
I couldn't imagine I would do. But I think it's, as an entrepreneur, the CEO and founder role certainly suited me more.
So the logical next question is, will you ever start a company again?
Probably yes. Probably yes. Look, I mean, my first priority is I really want the integration to go well. Perk. Yeah. I take my role as the Chief Spend Officer of a multi-million company global now very serious. I really want to hit our goals. And it also comes with some perks. I now have also some time for stuff I couldn't do before. I'm now on a couple of boards, which is really nice. So you can help entrepreneurs, especially in Switzerland, which I think is cool. So there's a new cybersecurity company coming up, Corix, where I'm on the board, which is really, really cool. And they started out early this year. So really changing or helping companies in the cybersecurity space. And I think I can help them a lot, really by just, helping them go through the early phases as kind of like having that outside view. Yeah. But Lars, my co-founder, which was 3 times on the podcast.
I stopped counting so often already.
Lars and I also launched an education platform for startups and SMEs in Switzerland, Zero to Exit.
Amazing.
Where we have the goal of strengthening the Swiss ecosystem. So we really want to help. I mean, we cannot help every single one, but with that education platform, I think what we can do, so we're recording videos and we hold sessions where we really dare to answer questions, to help entrepreneurs, but also to help SMEs, like how they become more agile, how they become more like startup-like. And these are things I really, really enjoy.
That's amazing. That's the right thing.
Yeah.
Wonderful. Now to wrap up today, Phil, we have some rapid fire questions for you. I'm going to just fire away and you have to answer ideally in 1 sentence. You ready?
Ready.
You were both a product machine and a sales engine at Yokoy if you had to pick one, product or sales.
Product.
What's your favorite Swiss food or drink?
Raclette.
Nice. Your go-to place in Switzerland to recover and recharge?
My home.
Where is that?
In Aarburg.
Nice. What's the most underrated Swiss value in entrepreneurship?
Trust.
You must know, you as a global CEO.
Yes, absolutely. Swiss people trust each other.
That's true. It really speeds things up. You don't need to build that trust first. You can just directly do business.
Yeah, but you need to hold your promise.
That's true. Otherwise, you're out of the game. And the last one for you. What's one very Swiss habit that you keep even when working now with global teams?
The precision.
Yeah, like on time, doing good quality work.
Yes.
Nice. I love that. Phil, thank you so much for being here today. It was very inspirational and also insightful. I wish you all the best and lots of success. And I'm sure it has not been the last time that you were sitting here in that chair.
I hope not. Lars was invited 3 times. No, thanks, Silvan. Thanks a lot.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.